The most dangerous debt in the world is not the debt you see. It is the debt held up by a habit the world may be starting to break. America owes a number so large that the human mind almost refuses to understand it. $39 trillion does not feel like money. It feels like weather. It feels like a political talking point. It feels too big to belong to ordinary life. But it does belong to ordinary life. It belongs to your mortgage rate. It belongs to the price of food. It belongs to the value of your savings. It belongs to the interest rate your business pays. It belongs to the taxes your children may face. It belongs to the purchasing power of every dollar you earn. A government can make debt look distant for a very long time if the rest of the world is willing to finance it. That is the arrangement most Americans never understood. For decades, the United States did not merely issue a currency. It operated a toll booth on the global economy. The world needed oil. Oil was priced in dollars, so the world needed dollars. Those dollars then came back into American financial markets, especially Treasury bonds. That returning money helped Washington borrow more easily, spend more freely, and keep the machinery running. Most Americans thought the dollar was strong simply because America was strong. That was partly true, but it was not the whole truth. The dollar was strong because the world had to use it. That is a different kind of strength. It is the strength of habit, architecture, energy, military protection, financial plumbing, and trust. It is powerful while everyone keeps driving through the toll booth. But if enough countries begin building roads around it, the toll booth does not collapse in one day. It simply collects less, then less again. Then the owner of the toll booth discovers how expensive the road system was to maintain. That is the first mechanism I want you to understand. I call it the dollar toll booth. Every reserve currency in history has enjoyed some version of this privilege. Other nations hold it, trade in it, borrow in it, and save in it because the system around it makes doing so convenient. The dominant currency becomes more than money. It becomes infrastructure. The dollar became the operating system of global trade, not only because of American productivity, but because of the energy system built after the end of the gold link. When the dollar was no longer convertible into gold, it needed a new anchor. Oil became that anchor. If you wanted energy, you needed dollars. If you earned dollars from selling, you often recycled those dollars into American assets. The loop was elegant. America imported real goods and exported paper claims. That is an extraordinary privilege. But privilege can make a nation careless. A household with an unlimited credit line may stop asking whether every expense is necessary. A government with the world's reserve currency may discover it can borrow longer, spend more, and delay harder choices. The bill does not vanish. It is spread across time and across the world. The second mechanism is the debt sponge. Foreign demand for dollars and treasuries acts like a sponge. It soaks up the paper America issues. When the sponge is large and thirsty, deficits are easier to finance. The Treasury sells debt, buyers appear, yields stay manageable, and the American public does not feel the full pressure immediately. That sponge is one reason the United States has been able to run large deficits without the punishment many smaller countries would face. If a small nation prints too much and borrows too much, its currency can fall quickly and its borrowing costs can jump. America had the advantage of issuing the currency the world itself needed. But the sponge is not a law of nature. It is a behavior. And behaviors change when incentives change. If countries need fewer dollars for oil, they may need fewer Treasury securities as reserve assets. If payment systems outside Western control become good enough, some trade can bypass the old rails. If reserve managers fear that dollar assets can be frozen in a geopolitical conflict, they will not necessarily abandon the dollar, but they may diversify. They may buy more gold. They may hold more local currency. They may settle more trade directly. They may reduce the portion of their reserves subject to another nation's switch. That is not a headline revolution. It is a slow bleed. Slow bleeds can be more dangerous than crashes because people ignore them until the weakness becomes structural. The third mechanism is the sanction scar. When a financial system is used as a weapon, the target feels pain, but the witnesses learn too. After Russia's reserves were frozen and major banks were cut from Western financial plumbing, other governments saw something that changed the meaning of safety. A reserve asset inside another nation's system can become conditional. It may be yours until someone with more power says it is not. That does not mean the action was unimportant or unjustified. Geopolitics is complicated, and nations use the tools they have. But markets do not only ask whether a tool was justified. They ask whether the tool now exists and might be used again. Once that question enters the mind of a central banker, reserve management changes. A country does not need to hate America to hedge America. A country does not need to abandon the dollar to reduce dependence on it. A country does not need to declare a new monetary order to quietly move a few percentage points of reserves into gold. Yuan settlement, local currency trade, or alternative payment rails. That is how great systems lose share. Not all at once. At the margin. I have watched businesses lose dominance this way. They remain enormous, they remain profitable, they remain respected, but customers start testing alternatives, suppliers build optionality, competitors become good enough. What was once unthinkable becomes merely inconvenient. Then what was inconvenient becomes normal. Reserve currencies can experience the same process. The fourth mechanism is the good enough road. A new system does not have to be better than the dollar system. In every respect to matter, it only has to be good enough for certain transactions among certain countries, under certain conditions. If China and a trading partner can settle directly, if oil can be sold in currencies other than dollars, if a digital bridge allows central banks to bypass old intermediaries, if local currency trade reduces exposure to sanctions, then a small amount of traffic moves off the toll road. At first, nobody notices. The toll road still has most of the cars. Then the side road is widened. More countries test it. More invoices are settled away from the dollar. More central banks become comfortable with alternatives. The dollar still dominates, but the habit is no longer absolute. The danger is not that the dollar disappears tomorrow. The danger is that America has priced its national behavior as if dollar demand is permanent. There is a great difference between being dominant and being invulnerable. The dollar is still dominant. It is deeply embedded in trade, finance, debt markets, banking, commodities, and reserves. No single alternative can replace it overnight. The euro has its own problems. The yuan is not freely open in the way the world would need for full reserve trust. Gold cannot finance trade as conveniently as a modern currency. New payment systems remain small relative to the vast dollar network. But the question is not whether one rival replaces the dollar in one clean act. The question is whether many small routes reduce the automatic demand that has allowed America to borrow with unusual comfort. That is enough to change your life. The fifth mechanism is the interest rate transmission chain. If foreign demand for treasuries weakens, treasury prices can fall and yields can rise. If treasury yields rise, mortgage rates often rise with them. If mortgage rates rise, housing affordability weakens. If borrowing costs rise, businesses invest less. If interest expense rises for the government, more tax revenue goes to paying for yesterday's borrowing instead of today's services. If the Federal Reserve tries to fight high rates by buying debt or cutting rates, it may risk more inflation or a weaker currency. That chain is how a foreign reserve decision becomes your monthly payment. People think de-dollarization is an abstract topic for economists and central bankers. It is not. It can show up in the price of a home. It can show up in the cost of refinancing. It can show up in the returns on bonds. It can show up in the price of imported goods. It can show up in the portion of the federal budget swallowed by interest. When a country owes tens of trillions, the interest rate is not a detail. It is the whole story. A 1% change on enormous debt can mean hundreds of billions over time. That money must come from somewhere. It comes from taxpayers, future borrowing, inflation, spending cuts, or some mixture of all four. There is no magic drawer in Washington where real resources sit untouched. The sixth mechanism is the reserve currency anesthesia. Reserve currency status numbs the patient. It allows deficits to hurt later. It allows imports to arrive in exchange for paper claims. It allows the government to borrow at scale. It allows the public to believe the pain is manageable because the pain has always been managed. But anesthesia is not a cure. It simply delays the sensation. When the world willingly holds your debt, you can behave in ways that would crush a smaller country sooner. You can run deficits, you can fight wars, you can expand programs, you can rescue markets, you can stimulate, you can promise, you can postpone the consequences or spread out because outside demand absorbs part of the burden. But if that outside demand weakens, the numbness fades. That is when the patient discovers what has been done to the body. I do not believe in panic. Panic is useless. I do believe in arithmetic. Arithmetic says that a country cannot indefinitely expand debt faster than productive capacity without eventually paying through taxes. Inflation, reduced spending power, higher rates, or some combination. Reserve privilege changes the timing. It does not repeal the principle. This is why Americans must stop thinking of national debt as someone else's problem. The country may owe it collectively, but the consequences are distributed individually. A weaker dollar raises the cost of imported goods. Higher yields raise mortgage and borrowing costs. Inflation weakens wages and savings. Financial repression can punish savers. Asset volatility can punish those who are over-leveraged. Tax changes can punish future income. Slower growth can punish workers. That is how the bill arrives. The seventh mechanism is the inside money trap. For a long time, the modern financial world has been built on inside money, promises, claims, bonds, deposits, digital balances, and government liabilities. These instruments are useful because they are liquid and scalable. They also depend on trust in governments, trust in banks, trust in payment systems, trust in legal treatment, trust in stability. When trust becomes less universal, outside money becomes more attractive. Outside money means assets that are not simply another party's promise. Gold, commodities, productive land, energy, businesses that create needed goods and services. Real assets with usefulness beyond a line on a ledger. This does not mean everyone should run from financial assets into commodities. That would be foolish. The world still needs financial claims. Businesses need capital. Governments need bond markets. Individuals need banks and payment systems. But an investor should understand the difference between a promise and a productive or tangible asset. A Treasury bond is a promise. A dollar is a policy instrument. A share of a good business is a claim on production. A farm is productive land. Oil is energy. Gold is no one's liability. Each behaves differently when trust changes. The eighth mechanism is the household translation. A nation with too much debt and a reserve system under pressure is not something you can control. You cannot decide how Saudi Arabia prices oil. You cannot decide whether China expands alternative payment rails. You cannot decide whether foreign central banks buy treasuries or gold. You cannot decide whether Washington runs a balanced budget. You cannot decide whether the dollar's share of reserves falls slowly or quickly. But you can decide how fragile your own household is. That is where most people need to focus. If the dollar's privilege weakens over time, the worst position is to be highly indebted in the wrong way, underinvested in productive assets, dependent on one paycheck, holding too much idle cash, and spending to maintain status. That household is exposed from every side. Inflation weakens savings. Higher rates raise costs. Job pressure threatens income. Asset inflation leaves them by end. Debt reduces flexibility. The stronger position is different. Low consumer debt, reasonable fixed obligations, a practical cash reserve, broad ownership of productive assets, skills that preserve earning power, some awareness of real assets and inflation hedges, a willingness to live below means, a plan that does not depend on the government preserving your purchasing power perfectly. That is not glamorous. It is durable. When I think about money, I do not begin with predictions. I begin with survivability. Can this person survive being wrong? Can this family survive higher rates? Can this investor survive a market crash? Can this business survive weaker demand? Can this retiree survive inflation? Can this country survive if the rest of the world becomes less eager to finance its habits? Survivability is the first rule of compounding. If you cannot remain in the game, the long term never arrives. The ninth mechanism is the ownership shield. If the dollar loses purchasing power over time, the answer is not simply to hate the dollar. The answer is to own assets that have a better chance of adjusting. A productive business can raise prices if it provides something valuable. A farm can produce food. Energy assets can produce energy. Real estate can provide shelter or rent. Though price and debt matter greatly, broad equity ownership can give the ordinary person a claim on companies adapting to inflation and global change. No asset is perfect. Stocks can fall. Real estate can be overpriced. Gold can sit unproductively for years. Commodities can be volatile foreign assets, carry political and currency risks. Cash loses purchasing power but provides optionality. The point is not to find a flawless shelter. The point is to stop standing naked in the storm. A well-built financial life owns several forms of resilience. Some liquidity, some productive ownership, low debt, earning power, discipline, optionality. These work together. The person who wants one magic asset is still thinking like a gambler. The person who builds a system is thinking like an owner. That is the identity flip. A consumer asks, what will happen to me if the system changes? An owner asks, what can I control before it does? A consumer waits for politicians to manage the debt. An owner reduces personal debt. A consumer worries about inflation. An owner buys productive claims and improves earning power. A consumer complains about high mortgage rates. An owner avoids needing reckless leverage. A consumer treats global monetary change as entertainment. An owner treats it as a reason to strengthen the household balance sheet. That is the change you must make. Now let us deal with the emotional temptation of doom. Doom is easy to sell. It makes people feel informed without requiring discipline. A man can say the dollar is doomed, the economy is finished, and the system is collapsing, and still do nothing useful with his own finances. He has confused intensity with preparation. I do not like that. The American economy has enormous strengths. It has productive businesses, innovative people, deep capital markets, strong institutions, despite their flaws, world-class universities, agricultural power, energy capacity, military reach, and a culture that still rewards building in many areas. Betting on sudden national collapse has been a poor business for a long time, but recognizing strength does not mean ignoring strain. A great company can have too much debt. A great family can live beyond its means. A great nation can abuse its monetary privilege. Strength can delay consequences, but it can also encourage complacency. The intelligent view is neither doom nor denial. It is preparation. The 10th mechanism is the slow empire tax. When a reserve currency loses share, citizens may not wake up one morning to disaster. More often, they experience a long decline in relative purchasing power. Imports become more expensive, rates become less forgiving, government budgets become more constrained, living standards feel harder to maintain. The country remains rich, but the old ease fades. This is how reserve privilege can erode, not with one dramatic crash, but with 1,000 adjustments. A mortgage that costs more, a grocery bill that strains more, a tax burden that rises, a government service that becomes worse, a currency that buys less abroad, a bond market that demands more yield, an asset market that becomes more volatile. The standard of living adjusts before the national story does. People will argue about the cause. Some will blame politics, some will blame corporations, some will blame foreign countries, some will blame central banks. There may be truth in many explanations, but the underlying structure is simple. If the world needs fewer of your liabilities, financing your lifestyle becomes harder. That is true for a person. It is true for a country. If your neighbors no longer want to lend to you, your spending must change. If the world no longer wants as many of your bonds, America's spending must change, or the cost of borrowing must rise, or the currency must weaken, or some combination must occur. There is no polite way around it. Now, what does a serious person do? First, stop confusing national privilege with personal security. The fact that the dollar has been dominant does not mean your savings are automatically safe. The fact that America is powerful does not mean your household can ignore debt, inflation, and asset ownership. Second, build a balance sheet that can live in a world of higher rates. Do not assume refinancing will rescue every bad decision. Do not buy a house only because the payment works under perfect conditions. Do not take floating rate or short-term obligations lightly. Rates are not just numbers, they are gravity. Third, own some of the productive world. Broad, low-cost ownership of good businesses remains one of the simplest ways an ordinary person can participate in economic adaptation. The specific vehicle depends on your situation, but the principle is clear. You want claims on production, not only claims on currency. Fourth, increase your earning power in a world where living costs rise and debt pressure grows. Human capital matters, skills, judgment, relationships, and reputation can protect you in ways no asset allocation can fully replace. A stronger income engine gives you more options. Fifth, keep enough liquidity. When systems wobble, people without liquidity become forced sellers. Cash may be a melting ice cube over long periods, but in short periods it can keep you alive. Hold it for a purpose, not as a religion. Sixth, reduce exposure to high-interest consumer debt. Credit card debt in an uncertain monetary environment is like sailing with a hole in the hull. Fix the hole before arguing about the weather. Seventh, diversify intelligently across assets, income sources, possibly geographies, and time horizons. Diversification is not a lack of conviction. It is humility about the future. Eighth, be careful with political narratives. A portfolio should not be built around anger. Many people lose money because they invest according to resentment. Instead of cash flows, valuation, and risk, the world may be changing, but discipline still matters. Ninth, watch what money does, not only what leaders say. Countries may speak politely while building alternative systems. Central banks may profess confidence while buying gold. Trade blocs may deny confrontation while settling more trade outside the dollar. Balance sheets often move before speeches admit the truth. 10th, prepare without becoming paranoid. A mind soaked in panic makes bad decisions. The goal is not to hide from the world. The goal is to become less dependent on any single promise. That is the operating system. It is not designed for a one-day crash. It is designed for a long adjustment. Most people are poorly prepared for long adjustments because there is no dramatic moment that forces action. If the dollar fell 50% tomorrow, everyone would react. If it loses purchasing power gradually while living costs rise, people complain but continue their habits. That slow process is more dangerous because it preserves denial. The same is true of debt. A household does not go broke the day it borrows too much. It goes broke when the payments remove every option. A country does not face consequences the day it crosses a dramatic debt number. It faces consequences when the marginal buyer demands more, when interest expense crowds out priorities, when inflation becomes the release valve, and when the rest of the world quietly builds alternatives. The warning signs are not always sirens. Sometimes they are payment systems with boring names. Sometimes they are oil transactions settled in different currencies. Sometimes they are gold purchases by central banks. Sometimes they are reserve share percentages drifting lower. Sometimes they are interest expense lines in a federal budget. Sometimes they are mortgage payments rising faster than incomes. A serious investor does not need fireworks before paying attention. Now, I want to be clear about something. The dollar can remain the leading currency for a very long time and still become less valuable to you. Personally, dominance is not the same as protection. You can win first place in a weak race. You can remain the largest currency while every unit buys less. You can be the cleanest dirty shirt, as people sometimes say, and still be dirty. That is why the right response is not to predict the exact fall of the dollar. The right response is to stop building your life as if dollars alone are permanent wealth. Dollars are useful, they are liquid, they pay bills, they settle debts, they give optionality, but they are not a complete store of long-term value when governments can create more and when global demand for them may be slowly changing. Productive ownership is different. A business selling essential goods can adjust prices. A railroad moves freight, a utility provides power. A farmland owner produces crops. A strong insurer prices risk. A software company with real utility can earn profits. A consumer brand with trust can survive currency changes. These are imperfect, but they are connected to real economic activity. That is why I have always preferred productive assets over idle claims whenever the price is sensible. But price is important. Do not use fear of the dollar as an excuse to overpay for anything. A good asset bought at a foolish price can still produce poor returns. Discipline remains the guardrail. The world may be shifting, but valuation has not been repealed. A frightened investor buys protection at any price. A disciplined investor builds resilience at reasonable prices. There is a difference. The 11th mechanism is the final domino illusion. People imagine the final domino as one event, a summit, a treaty, a currency announcement, a dollar crash, a headline declaring the old order over more often. The final domino falls after many smaller ones have already fallen quietly. A country settles one trade outside dollars. Another joins an alternative payment network. A central bank adds gold. An oil producer accepts another currency for a limited transaction. A buyer and seller agree to bypass the old route. A reserve manager lowers Treasury allocation slightly. A regional bloc builds settlement infrastructure. None of these seems decisive together. They change the default, and once the default changes, the old system no longer enjoys the same automatic flow. Defaults matter enormously. In personal finance, the default is why automatic retirement contributions work. In global finance, the default is why the dollar has been so strong. If every transaction naturally routes through dollars, dollar demand remains enormous. If more transactions have other defaults, demand changes. That is why the plumbing matters. People prefer dramatic stories about presidents, wars, and summits. But in money, plumbing often matters more than speeches. Settlement systems, reserve practices, invoicing habits, clearing networks, custody arrangements, and collateral choices are the hidden tracks beneath global power. The average citizen never sees those tracks. He feels them when the train changes direction. The final question is not whether America is doomed. That is the wrong question. Doom is too simple. The real question is whether Americans have become too dependent on a privilege they do not understand and too personally fragile to handle its erosion. If the answer is yes, then preparation is urgent, not panic. Preparation: a family can be prepared without believing the world ends tomorrow. A business can be prepared without stopping operations. An investor can be prepared without selling every asset. A nation could be prepared by spending responsibly, investing productively, and maintaining trust. Whether the nation does that is beyond your control. Whether you do that is not. So here is the mirror. How much of your life depends on low interest rates? How much depends on the dollar preserving purchasing power? How much depends on foreign buyers continuing to finance American deficits cheaply? How much depends on your paycheck rising faster than your costs? How much depends on assets never repricing? How much depends on politicians making disciplined choices with debt? If the answer is too much, you are not prepared, you are exposed. The solution is to reduce dependencies one by one. Do not wait for a currency crisis to care about purchasing power. Do not wait for mortgage rates to rise to care about debt. Do not wait for inflation to hurt to own productive assets. Do not wait for layoffs to improve your skills. Do not wait for markets to fall to build cash. Do not wait for the world to abandon a system before you realize it was a system. The dollar toll booth made America extraordinarily powerful. It helped finance a lifestyle, a military, a government, and an asset market that shaped the world. But toll booths depend on traffic. If traffic slowly diverts, the owner must either charge remaining users more, spend less maintaining the road, borrow more, or accept lower income in national terms. That means inflation, taxes, spending pressure, higher yields, weaker currency, or slower growth. In household terms, it means you must build your own road. A road made of low debt, a road made of productive ownership, a road made of earning power, a road made of liquidity, a road made of discipline, a road made of not needing the world to remain exactly as it was. That is how you protect yourself. The system may crack slowly. It may surprise us with resilience. It may adjust without catastrophe. It may remain dominant longer than critics expect. But the direction of pressure is clear enough to deserve respect. America's debt is not free because the bill has not arrived in one envelope. It is paid through interest rates, inflation, taxes, asset prices, and the quiet narrowing of choices. The world is testing routes around the old toll booth. The question is whether your financial life has any route around the consequences. If it does not, build one now.